what is the real difference between the cash basis on one side and the accrual basis on the other? We've been using the accrual basis in the very first beginning of this semester, while the cash basis was not that much used or never used. In accrual basis, as we know that whether the expense is paid or not, you would record it as long as it accrued. So if you, for example, stayed for a month renting a place for your company, then this would be recorded as rent expense, and let's say for 1,000. Whether you paid it or not, you're going to record it. So you could say here rent payable, for example. Rent payable. So you would say here rent payable, and rent payable would be for 1,000, and this is in the accrual basis. The same thing applies if you rendered the service and you didn't get any money. So account receivable would be debit for, let's say, 5,000, and then service revenue would be credit for 5,000. So in this case, what you're doing is you're just recording the expenses and the revenues if they incur. Contrary to that is the cash basis, where you do not record anything except if cash is involved. So if you pay for expenses, then you're recording them. If you didn't pay them, they're not recorded. The same thing goes for revenue. So if you collected revenue, then it's going to be recorded. If you didn't collect it, then it's not going to be recorded. And we saw before the unfairness of the cash basis as a measure of performance, because sometimes you would do all the work in one period, as we mentioned before, so all the work is done here, but the collection happened here. So in the second period where the collection happens, then this period will take all the credit, because this period will have all the money. So we would say, yeah, we collected the cash here, so this period's leader is very good, while this one is a loser, although this one has already done everything here, and this guy didn't do anything and then collected the cash. So that's why the accrual basis, we say that yes, accrual basis will recognize the revenue before we move into the other period, and the expenses too, of course. So before leaving to the other period, we would record here all the revenues which is generated in this period, whether it is collected or not. So basically what we do in the cash flow statement is that we are just going to take our cash basis, which is here, and transfer it into, we're going to take the accrual basis, which is here, and transfer it into cash basis. So what we'll do is we are going to transfer all our accrual basis into cash basis so that we can see exactly if those activities are done under the cash basis, how much cash would be generated from each of those activities. And that is what we are going to discuss next. So we are speaking about the statement of cash flows. And if you look at its meaning or its title, you'll find that cash is there. That's a very crucial thing, is that we are not going to record anything, almost anything in this statement, except if it takes a cash or cash equivalent form. So this is very important thing to remember, that if anything happens and it is not in cash or cash equivalent, I'll speak about cash equivalents in a while, so you wouldn't regard that as an item of the cash flow statement. So the cash flow statement basically is composed of three main categories. So here we have, the first one is the operating activities. So operating activities, and then we've got another one which is the investing activities, then a third which is financing activities. So each of the transactions which happens, if it is in cash, it will fall into one of those categories. So let's consider what is a cash and what's cash equivalent. So usually we say cash, of course it's known cash, whatever currency it is, it will be included here. Cash equivalents would be very highly liquid assets that could be transferred on the spot spontaneously into cash, such as gold, silver. It could also be government bonds or treasury bills. So the T-bills, those are as if you are giving a loan to the government. Those T-bills can be cashed at any time too. So the T-bills are also regarded as cash equivalent. So if any transaction being done by any of those means, then in this case it will be included into the cash flow statement and will fall into one of these three categories. So the next step would be that we want to start to know how to classify each of the transactions or the activities into those categories. So let's say that let's start by the operating activities. So the operating activities is anything which has to do with operations. Anything which has to do with the operations and generation of income from the core business would be falling into the operating activities. While in the investing activities will include those long-term investments, which are mainly investing in long-term assets, such as machines, equipment, buildings. You could also include long-term investments in other companies. So if your company bought shares in another company, this would also fall into the investing activities. Finally, we have the financing activities. So those financing activities would be those activities that the owners or lenders are doing to finance the company or to get the reward from the company. So what I mean by that is that if owners raise capital, it will fall into financing activities. If the company gets a loan from a bank, it will be in the financing activity. However, sometimes the company would, not sometimes, hopefully, that the company would repay back this loan, so redemption of loans and bonds, and paying back dividends to the owners. This would also be here regarded as financing activities. Now I'll go into step by step about some examples showing which will fall into the operating, the investing, and the financing activities.